My name is Mike Ross. I'm the owner of Lattice Wealth Management. I spent 34 years at one of the largest banks in the country, and then I went independent in 2021. So I've been independent about 2.5 years, and in that 2.5 years, I've spent time almost every week talking to other independent financial advisors, and I've developed some opinions on how the public can interact with independent financial advisors. The public has a big job choosing who to work with. That is because everyone, it seems, from a part-time insurance salesperson to an investment banker, calls themselves a financial advisor. And how can you decide which is which? There's all kinds of different lanes to choose. So I've developed 4 questions that anyone in the public can ask both their financial advisor and perhaps others as the time goes by to get an accurate feel for who they are best suited for. Now, naturally, you could do this by telephone. You could do this by Zoom or some other type of video setup, but I'm going to recommend you do it face to face. Please do it face to face. It's not urgent, but it's incredibly important. The differences, making bad choices here can cost you tens of thousands of dollars. So take your time, ask the questions, be thoughtful about the answers, and make your decisions. This isn't a friendship. This is a business relationship, and you ought to take it that way. So the first question I think you ought to ask any financial advisor is, what is the last continuing education course you have taken? And maybe you want to ask for the last 3. What I've discovered is that there are dozens, if not hundreds, of different continuing education courses for financial advisors. And what I've learned firsthand is the hurdle rate for getting something turned into a continuing education is pretty low. It's a pretty low bar to turn a presentation into CE. So ask what the last 1, maybe 2, maybe 3 different continuing education courses they have taken. What you're going to learn from this is 2 things. You're going to learn, number 1, what they are certified or licensed to do. And number 2, you're going to learn where their interests are. And from those 2 things, based upon your particular needs, you can make an objective, informed decision on whether they kind of meet what you're trying to accomplish. So that's the first question. The second question you ought to ask is, do they have investment minimums? So what you find is that depending on the company, different firms have different investment minimums. Now, one of them is really obvious. If you're working with a big bank that has pretty office buildings in nice parts of town, there's overhead associated with that. And it's going to go ultimately to the customer, that overhead. So recognize that that's one reason. The other reason, quite frankly, is because different firms have different target markets. So if what you have to invest and potentially have to invest is lower than their minimums, kind of take the clue, and that's not a good match for you. Now with this one, I'm going to suggest one caveat. And the caveat is, this is the time where you may want to, at least for a period of a few years, use the same advisor your parents or your aunts or your uncles have. Because, number 1, they want to retain the relationship once those people have passed, and you are most likely an heir, so they want to work with you even if you're below the minimums. And 2, they may be able to shed insight, frankly, into what you're going to have when the time comes. So they're going to want to work with you. They're not going to really care about the minimums, but the other ones, to be sure, if that's not your situation, if you don't have parents or aunts and uncles with substantial assets, make sure you're above someone's minimums. The third question you want to ask, and this is very, very important, and this is one of those you got to ask face to face so you can see the look on their face is, what is the normal contact cycle, contact routine, and what do we discuss on those meetings? So this is going to be one, again, all of these are subjective, but the first thing that is going to drive that contact routine is most likely the complexity of your situation. If you have a $100,000 IRA and you only talk once a quarter, that's fine. But now going to the what do we discuss portion of the question, okay, you ought to be discussing maybe a little bit markets and accounts, but you ought to be discussing tax issues, estate issues. You ought to be able to leverage their network of experts in other areas. It is really valuable for you to leverage their contacts. If you do have a large base of assets and it's complex, there's trust accounts, there's individual accounts, there's IRAs, there's retirement plans, that ought to merely tell you that you ought to be talking fairly frequently because there's a whole range of things to be talking about. And again, the discussions ought to be relative to your entire set of financial circumstances, okay? Now, there's a few things that are going to dictate how often they're willing to talk. The first one is their staffing, okay? In the course of my conversations with people, I have been simply amazed at the range of staffing. Now, I got to tell you, I'm a little bit unique here. I have two very long-term assistants. We've been working together in one case for over almost 25 years, in the other case for 10 years. So I have a very seasoned staff, which allows me to spend most of my day talking to clients and other professionals. But what I've discovered talking to this range is that you have some that have one assistant themselves, which is fine. You have some that are sharing an assistant who lives 3,000 miles away with 2 or 3 other people across the country with varying needs and varying interests. And then you have some that, quite frankly, have no assistants. Folks, this is a paperwork intense industry. So the idea that they have no assistants means they have to do all the paperwork. They're not going to have time to talk to clients. It's just too much. It's just too overwhelming. So the second thing you need to think about is what is their staffing? The third thing, and I think this may come through in other areas, is how many accounts, how many relationships do they have? So it's pretty common knowledge in the industry that any one advisor can have 50, 60, 70, 80, maybe even 90 relationships. Especially if they have good staffing, they can talk to that many people in a regular interval and maintain good relationships. I have run into situations where an individual advisor has 200 and 300 different relationships. Folks, you can't help that many people. You just don't have the time. So if someone likely even brags to you that they have 200 different clients, be very cautious about if you want to move forward with that person. The final thing is, again, there's a lot of different things that ought to be discussed between the client and the financial advisor. And it becomes a function of time. If you have somebody who is perhaps over 50 years old and they're going out and playing golf twice a week, or they have other activities that they're doing a lot, they simply don't have time to work with that number of clients. So in a case like that, get a sense of what their weekly routine is. When they're out playing golf, yeah, I'm sure they're playing with clients and things like that, but you're not really adding anything to the intellectual part of the conversation. You're simply out playing golf and chatting about things. So be very careful in terms of how much time they spend. The last question that you need to be asking, folks, and this may come up with the previous ones, is ask them the number of clients, which may have come out already, and then ask them about their assets under management, or AUM. Now, when you ask this question, preferably face-to-face, if you get a blank stare or they say, oh, I don't even know, be very cautious. Either A, they really don't know, and if so, they're very disorganized and I'd question the relationship, or B, they know and they don't want to tell you. Why do they not want to tell you? Because if you get a sense of their assets and their number of clients, and you just simply divide one number into the other, you're going to discover where kind of their average client assets lays. Okay, if you have $2 million and their average client's at 250,000, it is not a good relationship for you. They are not spending nearly enough time dealing with the situations that you're in the middle of or that will come to you. By the same token, if their assets for clients are 5 million and you have $500,000, they're not going to spend much time with you, and you need to think about that. So those very quickly and succinctly are the 4 questions. Ask them every 3 or 4 years, because things change in all of our lives every 3 or 4 years. And if you grow a little bit concerned with the answers, begin to ask other financial advisors, because what you may discover by asking these questions is that the fit you have right now isn't the appropriate one, and then you need to go shopping a little bit. Again, my name is Mike Ross. My company is Lattice Wealth Management. You can reach me by going via LinkedIn at Michael Ross at Lattice Wealth Management. You can reach me at my email address, which is mike.ross@mylatticewealth.com. And I'm happy to answer any follow-on questions. Thank you very much.